So again, hello and welcome. Today is part 2 in our retirement plan series. And in our last webinar, we spoke about traditional retirement plan options such as 401k, 403b, and 457 type plans. Whereas today's topic will focus on retirement plan options for smaller businesses and some of the basic plans to help people get started in offering retirement plans. So that will include things like simple, SEP, solo 401ks, and how even for solopreneurs, how you can take advantage of those tax benefits and savings. So I hope you all enjoy today's presentation. And with that, we do have a few folks on here today that are not clients of ASAP. So I'll give you a little bit of information about ASAP. I am Diana Murray. I'm the Vice President of Operations here at ASAP Accounting and Payroll, and I have been here 11 years. We actually have 3 offices, Durango, Denver, and Telluride, and we do service clients all over the United States. And we do offer bookkeeping and accounting services, as well as payroll processing and a bit of tech services, which is under our managed services realm. So that's a little bit about ASAP. And really what ASAP stands for here is as simple as possible. And it's our aim to really get folks doing back to what they do best. So whether that be our hike, bike, ski more, or even helping grow their business and not doing some of those tedious tasks like accounting and payroll. And with that, I want to introduce today's presenter. We have Ken Duncan with Western Wealth Management, and they are registered investment and brokerage services through LPL Financial. And he's done such a great job in servicing some of our clients and specializes in individuals and families, corporate executives, business owners, and charitable organizations. He's lived in Durango for over 20 years. And he's proud to have him and his family call the Western Slope home. And he's got a real passion for world culture and lots of stories, as I've heard. He attempts to see a different country every few years on vacation. And in 2007, he actually rode on his mountain bike from Western China to India via Tibet and Nepal. So an adventurer like many of us on the phone today. So without further ado, I'll go ahead and turn it over to you, Ken.
Hello, everyone. Good afternoon. Can everyone hear me okay?
Yep.
Okay. Well, first, thanks for being here on this afternoon. My aim is really to help each of you understand and navigate the retirement plan universe. You know, as my background, and Diana has alluded to, I'm a board certified financial planner. I was at Morgan Stanley for 6 years, and then I took my practice private about 4 years ago. And part of that is because I wanted to be my own business owner, as many of you are. And so I'll be talking like a business owner, and so hopefully we can relate to that. And, you know, I think some of these solutions that I'll present to you will allow, no matter what resources you have or what size of business you have, will allow you to be creative to offer more benefit options to your employees and allow more tax deferral strategies, not only for your business, but for those valuable employees as well. So the way I want to begin this presentation is to talk about the very basics of retirement plans. And I'm going to start with very, very simple type plans, and then we'll get more complex as we go along. So, so the very first type of retirement plan, and what I usually bring up as an idea, this is really good for companies that are just starting out, might have limited profit or nonprofits, do not want to match dollars, but want to allow their employees to have the ability to defer some type of income into a retirement plan. And the beginning of any type of retirement plans, it all starts with a payroll deducted IRA. Now, a payroll deducted IRA is the simplest way workers can save for retirement. what would happen is the employees would set up a traditional or Roth IRA on their own, and then let the employer know how much they'd like to contribute from each paycheck. So the real difference here is that it would come directly from your payroll and go right into their IRA. Any employer or sole proprietor can set up a payroll deduction IRA program. And the eligibility for employees, employers who set up a payroll deduction IRA must allow all employees to participate. So basically every employee is eligible, but the employees are responsible for setting up the IRA, and they must meet IRA eligibility requirements. Basically, they just need to be employed and receive a W-2 paycheck. Basically, employees determine how much of their paychecks they want to contribute to their IRAs. And it would work very much like a personal IRA in terms of the amounts that they could contribute. So they're capped at $5,500 if they're under 50, or $6,500 if they're 50 or older. The reason why people use payroll deducted IRAs is that they're extremely simple. And for employers like ourselves, there's no matching requirements. So there's no extra dollars that come out of your profit coffers or your extra savings accounts that goes to the employees. The tax benefits are the exact same as they would offer through regular IRAs, except for the fact that it would come through their actual paycheck. So traditional IRA contributions are made before taxes are deducted, which means that income taxes are not paid at the time of investment. Instead, taxes will be paid when the money is withdrawn, and including on any earnings, so it will grow tax-free as well. This deferred tax leaves more money in the employees' pockets, monies to invest, and hopefully spend when they are retired. They can also set up a Roth IRA, which are made with money that has been already taxed, but it will grow tax-free, and then when they withdraw it, it will be withdrawn tax-free. So that's really what a payroll deducted IRA is, and a lot of people don't really know that they have the ability to offer that to their employees. It's very simple to administer. The costs are very low. Now, let's say that you want to have, let's say that you're running some specific profit in the business, and you want to keep some employees and offer them a little bit more, not only a robust type of retirement plan, but give them some more incentives like a match. Well, then the next step would be looking towards a simple IRA plan. So simple IRAs are good for companies that are allowed for 100 or fewer employees. What is a simple IRA plan? Well, it's a tax-deferred retirement plan designed specifically for small businesses. Fewer than 100 employees are allowed. It's easy to establish and maintain, which means that there's a limited fiduciary responsibility. The contribution limits for each employee would go up. So instead of that $5,500, it would go up to $12,500. And if they were 50 years or older, your employees could contribute $15,500 into their retirement account. The biggest difference here between a payroll deducted IRA and a simple IRA plan is that it requires an employer match, and it has immediate vesting, meaning when you, the employer, makes a match, which is usually 3% of the employee's salary, then that match money is completely vested, so that if you would lose that employee within that year, they would take 100% of that match money with them. If a company has limited cash flow and does not want to match, then I would look towards a payroll deducted IRA. Now let's talk about employee eligibility for simple IRA plans and who can participate in the simple. An employee, including a self-employed individual who has earned at least $5,000 in compensation during any 2 years before the current calendar year, and expects to receive at least $5,000 of compensation during the current calendar year. You can exclude employees that do not meet that requirement. An employer can use less restrictive participation requirements, but not more restrictive ones. For example, an employer can eliminate or reduce the prior or current year compensation amounts, but employers cannot impose any other conditions for participating in a simple IRA. So the way I look at this, and when I present this to my clients, is I want them to look about 3% of their payroll. And if they have the ability to give 3% of their payroll to their employees, well, that's what the match would end up being. And that number obviously gets deducted, so you're not taxed on that at the end of the year. It's an extra incentive for your employees to stay if they know that there is match money coming. And at the end of the day, it's a great way to promote reliability and the loyalty of any employee, especially when they know that they're getting a match here and maybe not a match from one of your competitors. Now, the difference is the employer match. That's really the biggest difference between a simple and a payroll deducted IRA. So you can choose, the employer must annually choose one of the contribution methods below. The employer must tell the employees during the election period which method will be used for the following year. So you can do a 2% non-elective contribution, which means that even if the employee doesn't defer any money, you would contribute 2% of their salary to their simple IRA. But most likely, and what people do is that they would rather have people participate in the plan, defer their own money, and 3% matching contribution is the most popular. And that means that basically, as the employer, you match of the employee's elective deferral on a dollar-for-dollar basis up to 3% of the employee's compensation. So, for example, if the employee was making $50,000 and they contributed $1,500 of their own money into their simple IRA, you would match it dollar for dollar up to that 3% or $1,500. Now, you may reduce the 3% limit to a lower percentage, but in any event, not lower than 1%. And you may not lower the 3% for more than 2 calendar years out of a 5-year period, ending with the calendar year the reduction is effective. Most likely this never happens, but they put this in there for companies that are having tighter cash flow issues. Matches are really good for companies that are profitable. So that's something that you might want to consider before employing a simple IRA. And the employer cannot make any other contributions to a simple IRA plan. So basically, besides that 3%, there's no bonuses that could go in there. Simple IRA plans are very cost effective. In fact, they have a little bit more of administration than payroll deducted IRAs, but not much. They're not subject to the Department of Labor or FINRA rules. There are certain things that we do have to do, but it's not regulated like a 401k. And the cost is very similar to what a payroll deducted IRA can be. So now, that's if you have 100 or fewer employees. So for the employers out there that have over 5 employees, even over 2 employees, these 2 options are really your first entryway into retirement plans. Now, the next two plans that I'm going to talk about are really for those that are self-employed or solo practitioners. And we'll talk about the self-employed pension IRA plans. Basically, the ideal company size here is small. It's 1 to 5 people. What is a SEP IRA plan? So it's an employer-sponsored plan, which you set up, which contributions are made to the participating employee's IRA. Now, the biggest difference between a SEP and the previous two plans that I have discussed is that a SEP provides for employer contributions only. It's easy to establish and maintain, and the contribution limits are different as well. The maximum contribution cannot exceed the lesser of 25% of total compensation of either $54,000 or $55,000 of 2018. Now that 54 or 55,000 for 2018 is what we need to focus on. But that 55,000 is not the salary. That would be 25% of the salary up to $55,000. So self-employed pensions are really good for those solo practitioners that have very high revenue, very high profits, and are able to pay themselves a big salary. And then you can take that salary, times it by 25%, and then that's what your total contribution could be each year. It's a fantastic way to build retirement assets in a short period of time. But there are some limitations when you try to set one of these up with employees. Employer contribution percentage must be equal to all eligible employees. So, for example, like I said with the simple IRA plan, and I said, hey, calculate 3% of your total payroll. Well, with a SEP, you have to calculate a much higher percentage. So if you're the owner of the business and you want to give yourself 20% of your salary, you have to give the same 20% to all your employees. So that can be challenging, especially considering the different merits of different employees at different times. And that's kind of the limiting factor of a SEP plan. Employee elective deferrals and catch-up contributions are not permitted in a SEP plan. So the employee might be earning $100,000 a year, but the employee cannot defer his salary into this plan as well. So that's another limitation to a SEP. But it really works well for people that are on their own or maybe have one other key employee. The differences between a SEP IRA is that it's a simple administration than a 401k, very easy to set up. You gain simplicity, but you lose flexibility with regard to the participation requirements. It provides only for employer contributions, not employee deferrals. Contributions for employees must be the same percentage as owners. And all contributions are 100% vested. So just imagine as an employer and you try to set up a SEP and you give 20% of your payroll, not only to yourself, but then to your employees, and then 2 employees quit on you. So that's really a risk there. So that's where we would come to me or someone like me that would set up a plan designed for you, and we can go through these various options. So that's really the SEP IRAs. Now, the next thing I'm going to talk about is going to be a solo 401k, and I'm going to stop sharing my screen and just do a video here, if that's okay. And basically, I wanted to talk to you a little bit about a solo 401k, because a solo 401k works very similar to a SEP IRA in that it's designed for 1 to 2 people. Solo 401ks are great for people that have high revenues and high profits. For example, people like in my business, I have a solo 401k. What that means is that I get the contribution limits of a regular 401k, so that's $18,000. So I can defer $18,000 of my personal salary into my solo 401k. Then on top of that, I can put up to 20% of my profit or 20% of my salary into my 401k each year. And that's also capped at $55,000. So basically, I get the salary deferral, which a SEP IRA doesn't allow me to have, right? And I get the ability to put in that percentage of my salary into a solo 401k as well. It's very, very good for building retirement assets quickly. I highly recommend it for people that are on their own and that are over the age of 50, that don't have any retirement assets. And the other good reason for a solo 401k is that it's easy to administer than a regular 401k. It costs more than a SEP, a simple, or a payroll deducted IRA. But the monies that you put into that 401k are protected from your creditors. And you can also take loans against that 401k to purchase things like a home, to pay off a car. So it kind of works as an emergency reserve account as well. So those really are the 4 plans I want to talk to you about. I will take questions now from anybody, and then also talk to you a little bit further specifically on the type of business that you have. While we're fielding questions, I'll just kind of say a couple things about the payroll deducted IRA. Those are fantastic for nonprofits. And then also for the simple IRA, those are really good for companies that run a profit and that have, over 4 to 5 employees. But that payroll deducted IRA is really a neat deal that most people don't even know about. So I'm willing to take any questions now, and sorry if I spoke
No worries.
too fast.
No worries at all. Thanks, Ken. We do have one question that come in. What is your input on a 403B?
Oh, well, 403B would work just like a 401k plan, which we're not talking about today. But a 403B is for for those 503C nonprofits or government agencies as well. So that's something that is with the 401k people, and that would have been a better question for, I guess, the previous webinar.
Oh yeah, no worries. And can you talk maybe just briefly about the difference between that and the payroll deducted IRA? And like this probably is it for a nonprofit asking this in terms of like which avenues should they look at, and maybe some high level differences between the two.
Yeah, so I mean, bottom line, as a business owner, the running a 403B or even a 401k is going to take up a lot of administration time. It's going to take up a lot of hours to administer. You've got reports that you need to file with not only the IRS, but the Department of Labor, and it opens you up for potential audits. With a payroll deducted IRA, the administration costs go way down because you're not spending your own manpower of hours setting up the accounts. The employees set up the accounts on their own. And really, from an administration standpoint, once it's set up, you just call ASAP and say, hey, we have a payroll deducted IRA. Here's the percentage of salary that we want to go into each IRA account. And then ASAP would take over from there. So it's a very easy way to administer and saves a lot of money, not only from an administration standpoint, but from a compliance standpoint as well.
Yeah, and I think one of the things that stood out to me when you were talking is really it's an entryway into it with less regulation and less costs. and just less complexity and compliance and reporting aspects built into it. So thanks for touching on that again. One question that I had is in terms of like when you do have a match set up with these types of plans, is there still like the potential to kind of customize a vesting schedule, or if you could touch on that?
Yeah, there is not with these non-qualified plans. So for the simple IRA that has a match, and for the SEP IRA, which is a mandatory match, if you give yourself a percentage of salary as an owner, you have to give each employees. You're not able to set up a vesting schedule, and that's the downside of these, is that the vesting schedule will allow you to incentivize loyalty from your employees, because if you have a vesting schedule, that means that in year 2, you're 20% vested. In year 3, you're 40% vested, and it just really incentivizes the employee to stay longer to get more of that matched dollar in their account. But no, with a simple IRA and with a SEP IRA, there is no vesting schedule. And then with a solo 401k, it's really only set up for people that are sole proprietors or that are sole practitioners. And they could include their spouse in the solo 401k, but they could not include anyone else. So there would be no vesting schedule there either. You wouldn't want one if you were doing that kind of high level retirement plan.
And then in terms of like the process, is there any timelines in terms of setting up a plan through like these throughout the year? Are there any deadlines or anything that someone needs to consider when kind of shopping, or what's the steps in starting to set up a plan like this?
Yeah, that's a really good question. So with a simple IRA plan, the simple IRA plan is really the only plan that does have a schedule that you need to abide by. And so how it works is there's a notification schedule of 60 days for your employees, just explaining that, hey, we are setting up a simple plan. And then that allows the employees to set up each of their accounts, either with the institution that the employer chooses, or you can set up an option that says, hey, each employee can choose with their own institution that they want. Most likely, most employers want to just pick one institution because it really cuts down on administrative costs. But once the client or once the employee gets the notification, then there's kind of a go live date for that plan. And right now, if you want to set up a simple IRA plan, we want to send out that notification really by October 1st, so that you have October and November, and then you can go live on December 1st. So that's really how it works. It's about a 2-month out for a simple plan. With a payroll deducted IRA, those can be started anytime. There is no requirements. And then also, it's funny, with a SEP and a solo 401k, there really are no requirements either for a timeline, just with a simple plan. So I've set up simple 401k plans really the last week of the year. And we've run a whole payroll through through one payroll where we deferred all the max for that employee, that owner, and then we also did a contribution. So we've been able to save people, up to $55,000 of taxes in just a week's time with those solo 401ks.
That's a great point.
Yeah, it's pretty amazing.
Especially one with year-end approaching, and as people kind of look at their financials and look at their tax situations, it's great if you aren't taking advantage of some of these options to go ahead and capitalize on that. So Thank you everyone for participating today. Thank you so much to Ken for his time. Thank you, Ken Duncan with Western Wealth Management, and some great stuff for us to ponder. And again, we will have this recording available to you all. So thanks so much. Have a great day.